Amit Khurana, head of equities at Dolat Capital Market, is with us on the show now. Amit, we've seen a bit of a shave off in the prices of IT stocks. But given the run-up that we've seen in the stocks over the last 3 months, stock prices have gone up 8, 9%, and outperforming the market. Do you think we could see some more correction in the IT stocks, given what we've seen from TCS in the commentary?
Well, yeah, I think that looks like it building up as a case. I mean, of course, this is only one company reporting, but it does tend to be a trend setter. Today, you have the other biggies reporting in. From a slightly more longer-term perspective, I think we were building in such kind of muted growth, and therefore our stance on IT was a bit cautious, slightly on the negative side. So the recent rally that you were referring to on the IT stocks, I think it was more of a tactical rally, which is probably largely played out. And from here onwards, you don't see much triggers for a performance on the positive side. So the stocks will probably meander around this range for the next quarter or two. That's largely the narrative that we are building up now.
Okay, got that. That's the overall take on IT. Amit, hi. Good morning. What's the sense on the market as a whole? We have, we touched 20,000, then it's been consolidation, one negative headline to the other, US rates, geopolitics, etc., etc. So overall, what are you telling your clients and your investors to do?
Well, markets, I guess, if I were to put it in an analogy, are probably in the digestive phase. They have really absorbed a lot of information, a lot of events, a lot of headwinds, tailwinds. All of that went through over the last 7-8 months. And this quarter probably is, largely contingent upon the festival recovery, demand coming back. So a lot of narratives are being put out. Our take is that this is a market which is not going to go anywhere from an index perspective over the next few months, because you still have a lot of events which will keep it either the upside capped or the downside protected. So it's a slightly contrarian statement to give, but that's really the reality we're facing, because downsides are getting bought into pretty aggressively by the domestic guys, while the upsides, you keep getting those bouts of selling by the global funds, or here and there the technical sales come in. But having said that, I think the bottoms up stories will continue to do well, and that's been our narrative right from the times of May, June, when we put out the note saying that the rally is largely getting captured, and therefore from here onwards the returns will be more bottoms up rather than index-led. I don't see a reason to change that narrative. I think that will very well likely be the narrative for the next 2 quarters if I were to stick my neck out, because you then again get into the lot of election scenarios in India, a lot of other narratives which will start putting up as a case in point. So earnings are fine. We're trending towards still high 20s, high teens earnings in the quarter. So largely that is captured. I think new information probably we will absorb, but in the interim, digestive phase keeps on going, and market will keep trying to absorb more information and take a view.
Okay, so like you said, maybe not too much that we can see on an index level. But Amit, if you do look for opportunities in this market, do you still see a lot coming through from the broader markets, from the mid and small cap space? Or do you think that those pockets have become so expensive that you wouldn't feel comfortable getting in now? And do you prefer the large caps in that context?
Well, yes, technically we did call that out in the interim. But again, the large cap, most of them are reasonably valued. I mean, I would not call them expensive, but there is very little, shall I say, delta to make on those as an outperformance case. For example, banks, we probably have the best of the health of the balance sheet on their credit books. Largely, the credit growth is trending reasonably well. But the performance from the sector, obviously, because of the overbought status, everybody has the stocks. And then, of course, the concerns on the rate hikes continue to be stickier, tends to limit the performance. So if the idea is to look out for large caps as a hiding ground, then yes, obviously that there's a case to build around that narrative. But from a mid cap and small cap perspective, what we saw was probably more of a ripple effect, because most of these mid cap and small cap names, even the good quality names, actually did not perform for almost 15-18 months, starting from the peaks of October of 21 right down to the April, May, June this year. There was hardly any performance. So it was probably a catch up on that. They have become expensive. Selective pockets have become expensive. And therefore, we've been avoiding to sort of allocate incremental money on that. But having said that, there are still pockets which we believe are structurally in a right sweet spot, either because the business itself is in the right sort of frame on the balance sheet, on the cash flows, on the earnings visibility, or second, there is a reason for the sustainability of the growth itself. So you are willing to pay a bit of a premium for that kind of a business model. So it's a mix of the two, but very clearly we're focused on bottoms-up names, bottoms-up stories.
Amit, you want to talk about some of your interesting ideas that you've picked up in the last 1 or 2 months? Don't want to go back in time because those stocks may have already given large returns. But just in the last 1 or 2 months, what are the stocks that you've recommended?
So we initiated on India Mart. That was one of the names that we were pretty sort of doing some real deep work around that. We believe that the entire integration of the acquisitions, the way the capital allocation is being now structured, will put them into a much better status. The monetization of the entire model can have significant upsides to the earnings trajectory. Again, optically, it looks expensive, but based on our comfort, that is one name that we have initiated the coverage on in the recent past.
You said valuations optically look expensive. Do you want to tell us a little bit more on India Mart's valuations and why do you think the risk reward is still favorable?
Well, essentially, we are taking a call for the next 2 to 3 years because this is a B2B business servicing the requirements of the MSMEs. And as the MSMEs become more and more organized and structured in their way of approaching the businesses, their requirement for the services offered by India Mart becomes more and more apparent. When I said optically expensive, because this is a stock which has gone through a lot of acquisitions in the last couple of years, and therefore the throughput, the return on capital on those will eventually play out over the next 2 to 3 years. That's the hypothesis that we are running. So when you look at FY24, it may look, PE-wise, it may look very, very expensive, 50s and plus beyond that. But what we are trying to suggest is that this is a business which has an annuity kind of a model, and therefore the return on equity and return on capital have to be looked at it more from a 2 to 3 year perspective. And their ability to upgrade these MSME accounts over a period of time can drive the earnings. That's the hypothesis that we're putting out.
All right, Amit, thanks a lot for that. Very interesting chat, and we hope to have you back on the show soon so we can discuss some more of your new ideas. With that, it is time for a short break now, but when we return,